What's up, all you tax maniacs? This is your corporate tax compatriot, Andrew Van Sickle. Today I'm covering learning objectives 2 and 3 of Chapter 8. So on today's agenda, we'll start off talking about the tax basis of stock received. Then I'll define boot for you and discuss several scenarios. When a shareholder gets boot, when a corporation absorbs shareholder liability, when a corporation receives a depreciable asset, and what happens to a corporation that is exchanging its stock. Finally, we'll touch on capital contribution. So let's get started. These boots are made for walking. In a tax-deferred Section 351 exchange, the basis of the property transferred is swapped with the basis of the property or stock received. In a subsequent example, we'll calculate the tax basis for stock received in a Section 351 exchange, but this is just the general calculation of that. So in a Section 351 exchange for Betty Boop, she gave up the following to her corporation in exchange for 50 shares. So she handed over inventory with fair market value of $50,000 and adjusted basis of $25,000, a building with fair market value of $150,000 and basis of $75,000, and land with a fair market value of $300,000 versus adjusted basis of $110,000, and she was able to shed a mortgage liability of $100,000 in exchange for stock in Betty Boop's boutique with a fair market value of $400,000. But to calculate her tax basis in the stock, first we'll take a look at the gain or loss realized, and then we'll figure out what her tax basis in the stock actually is. So to calculate first the gain realized by Betty, we'll start with the fair market value of the stock she got and add in the mortgage liability that the corporation will absorb. So $400,000 plus the $100,000 mortgage liability that she's handing over, and that gives us the amount realized of $500,000. Then we have to subtract the adjusted basis of what Betty transferred over, the $210,000, to end up with her gain realized of $290,000. Okay, so let's move on to her tax basis. We begin with the adjusted basis of what she gave up, or $210,000, and then we'll subtract the $100,000 mortgage that Betty Boop's boutique will take on. That gives us, with the tax basis of the stock that Betty gets in return, of $110,000. So I know you're thinking, what's with all the boot puns? So boot is the gain, and it's never a loss, that a shareholder recognizes when they receive non-stock property. Gain is recognized by distributing boot to each of the property's fair market value. The tax basis of boot is its fair market value, and the tax basis of the stock received equals cash contributed plus the tax basis of other property contributed plus the gain recognized from the transfer minus the boot and liabilities being shed to the corporation. Now let's talk about the tax implication of liability transfer from the corporation's perspective. There is potential for abuse if the liability assumed by the corporation is actually determined to be boot. If any liability determined to be tax avoidance, then all the liability is treated as boot. The same applies is if the liability transferred doesn't have business purpose. So even assuming the liability is not considered boot, the taxpayer must recognize gain where liabilities given to the corporation are more than the tax basis of the properties transferred. The exception here is if the payment of the liabilities absorbed leads to deductions. If that's the case, then the liability isn't counted towards the check on the basis. In this exchange, the tax-paying corporation does not consider this to be a gain or a loss. The basis of the asset carries over from the giver to the taker, in essence, the corporation. If the basis carries over, the holding period of the asset does too. But the property's aggregate tax basis can't be greater than the fair market value of the property. So assuming there's a carryover basis, there's carryover depreciation of the transferred asset. The corporation continues depreciation where the shareholder left off. If there's appreciation and thus there's additional basis, then it's actually treated as a separate asset, and the government will doubly tax the asset. And this is a graphical representation of what happens to the taxpayer in that event. Capital contribution is the event a corporation, it's in the event a corporation receives property, but it doesn't have to give up any stock in return. So if it was given to the corporation by a shareholder, they take the carryover basis. If someone was generous and a non-shareholder gave the property for no stock, then the corporation in that case will recognize an income. This is my works cited, all from the textbook. Thank you so much for listening and watching. I hope you enjoyed this and got as much out of this as I had fun putting into it and making it. Thank you.